So you want to grow your dividends over time, but also make capital gains along the way? This might just be the ETF for you. The iShares Core Dividend Growth ETF, ticker symbol DGRO, is one of the most popular funds among dividend growth investors, and today I will answer the question, is its fame deserved, and can it help you achieve your long-term goals? I will do a deep dive into how the index behind DGRO is constructed so that you know what to expect from the ETF in the future. Then we'll take a look at the fund's age and what it means for it, the dividend yield and growth, its overall performance, and the level of diversification you get with it. After that, I will take a look at the sectors the ETF is invested in and what it means for the fund. Then you will get my opinion on who is the ETF for and not for. And finally, we will use my favorite dividend Snowball calculator to see how our investment in DGRO will grow in the future and how much dividends can we expect to receive. My name is Ognian and welcome to the Dividend Method channel, where we talk about investing and personal finance, and I help people achieve or at least get closer to financial freedom. For those that are new to investing, ETFs are basically basket of stocks following certain strategy and methodology. The iShares Core Dividend Growth ETF, or DGRO, is a dividend-oriented fund with $24 billion in assets under management, so it's a decently sized ETF. It was created in 2014. This is important, and I will come back later to the inception date to explain why. Also, the fund has a very low expense ratio of only 0.08%, which means you will only pay $8 per $10,000 investment. DGRO follows the Morningstar US Dividend Growth Index, a subset of the Morningstar Dividend Growth Indexes, which are created to track companies with a history of consistent dividend growth and the ability to sustain that growth. When I analyze ETFs, I always pay very close attention to the index the ETF follows, because this is the only way to truly understand where your money is going. When we invest in ETFs, we invest in a rule-based system. And if we don't know what those rules are, we're basically investing blindly. So let's dive into the Morningstar US Dividend Growth Index and find out what we can expect from DGRO. Right at the beginning, we know we're in the right place if we are hardcore dividend growth investors, because on the Morningstar website, it is literally stated that the index is created to provide exposure to stocks with a history of uninterrupted dividend growth and the capacity to sustain that growth, which is basically the definition of the dividend growth investing strategy. As a start, I find it important to note the index doesn't incorporate environmental, social, or governance criteria, which I find awesome. I'm ready to argue to the death with the ESG crowd that subjective morals have no place in the corporate world and should be discussed in the parliament and in courts, not in business meetings, but this is a topic for another video. What is important to know is that your money will be going to the stocks that will give you the greatest return according to the rules of the index, not some arbitrary moral code. Oh, and by the way, guys, if you're seeing and hearing the word indexes and you're wondering what is happening, this is just because the particular document from Morningstar website is describing the parent dividend growth indexes rules, which the index behind DGRO is part of. It's just that it's only applied to US companies. Okay, so what are the filters applied for the companies? Well, as an obvious start, as I said, they have to be from the USA, because the Morningstar US Dividend Growth Index is derived from the Morningstar US Market Index. Then things get interesting. First, the dividend yield of the companies must not be in the top 10% of the eligible investing universe. I find this very interesting and have mixed feelings about it. Basically, what Morningstar is trying to do here is filter out stocks that are so-called yield traps. A yield trap is basically a company that has a very high but unsustainable dividend. Usually, the stock has fallen out of favor and investors are selling it, which lowers the price of the stock, which in turn automatically increases the dividend yield. Why? Because the dividends are paid in fixed dollar amounts, and when the share price of a company tumbles, the percentage of the dividend goes up. However, a lot of times these companies have low prices for a reason, and they often have some fundamental problem like shrinking market share or a lot of debt, etc. This eventually leads to a cut in the dividend, which acts as a double punch in the gut for investors who have already been losing from the share price depreciation. Sometimes those dividend yields are also called sucker yields, and avoiding them is one of the most important skills for any dividend investor. With this rule, Morningstar is trying to do a shotgun approach of avoiding those types of stocks. On the surface, it is a good thing, but in my opinion, there are a lot more sophisticated and precise ways of doing it using fundamental metrics, like screening for free cash flow, payout ratios, and other ways which are beyond the scope of this video. The current form of the filter might lead to excluding good companies that simply have a business model that doesn't require them to maintain a lot of cash, and they distribute it to their shareholders. The next screen is that the dividends must be qualified income. I won't get into the weeds of it as it is related to taxes and it's not applicable for people in different countries, but what you need to know is that for USA investors this means a preferential tax treatment, and it also means the exclusion of real estate investment trusts. This is good for some investors because of the lower taxes, but it also lowers the yield of DGRO and it unnecessarily excludes a whole sector full of higher yielding but solid companies. The next filter is that companies in the fund need to have at least 5 years of uninterrupted dividend growth streak. This screen obviously ensures that all the stocks in the ETF have been growing their dividends recently. However, I think that 5 years is a very short time in order to judge whether a company is a consistent dividend grower or not. If the index wanted to include companies that are a more secure bet for continually growing dividends, that time frame should be at least 10 years in my opinion. However, the positive here is that by adding the companies in the ETF while they're on their 5th year in their dividend growth streak, the fund will be able to capture more upside before these businesses eventually become better known and added into other ETFs when they reach a 10, 15 or 20-year growing streak, or even enter the Elite Dividend Aristocrats list. So for this screen, I'm a bit torn between the positive and the negative side. If you're a more conservative investor, you want longer track record of dividend growth for maximizing security. However, more growth-oriented investors would prefer to capture the company's upside before it gets into more elite lists of dividend ETFs that track stocks with longer time of growing their dividends and growth history. The next filter is my favorite of the filters in the index. It screens for companies with positive consensus earnings forecast and a dividend payout ratio less than 75%. Let's unpack what that means. First, positive consensus earnings forecast. This means that financial analysts collectively agree that the company's profits are expected to grow in the future. This is a great indicator because it is one of the few examples where I have seen future-looking metrics applied to an index instead of only past-looking like dividend growth streaks, payout ratio for the past 12 months, etc., etc. Speaking of payout ratio, this is the percentage of earnings a company pays to shareholders as dividends. If a company earns $1 and pays out 75 cents as dividends, that's a 75% payout ratio. What the index is looking for is companies that pay out less than 75% of their earnings. Why? Because it shows they're keeping enough cash to reinvest in their business, aiming for more growth while still rewarding you, the investor, with dividends. This also shows the ability to still continue to pay a dividend if the profits are less for a year or two. Obviously, the business has some reserve from which to pull money, unlike a stock that has a 99% payout ratio, and one bad quarter can lead to a dividend cut. This is a great filter to have, although I personally prefer another metric to evaluate the health of the dividend. The metric is dividends as a percentage of levered free cash flow, not earnings, and it gives you a lot clearer picture of the sustainability of the dividend. However, this is beyond the scope of DGRO's analysis, and I have a whole video on the topic, which you can find on my channel, but only after you have finished watching this one. Alright, so these are the filters, or also known as screens, applied to the index. Now we get into the question of diversification and concentration. When you evaluate an ETF, you should always look for the rules in the index document that tell you what is the individual stock or a sector maximum percentage of the fund. Otherwise, if there aren't any constraints, you might get into a situation where you have an ETF out of which 2 companies have 50%, which defeats the purpose of the fund. So for the index behind DGRO, we have a pretty good diversification rule that I personally like. No company can become more than 3% of the index. Quite honestly, 3% even seems a bit low. Generally, I'm okay with the best companies having up to about 5 to 6% of an ETF, but I won't complain about a 3% rule. Next, we see that the weighing of the companies is not according to the size, but according to the dividend dollar amount. This is not something you see often, as most ETFs weigh the companies according to their size or yield. Here, however, we have the total amount of the dividends paid as the metric determining what part of the ETF a stock will be. Personally, I think this is a bit weird because no one really cares about what the total amount of the dividend a company pays is. People care only about the dividend per share and the dividends related to the price, also known as dividend yield. That metric will naturally skew the ETF towards bigger companies since, of course, a company that is bigger will pay bigger total amount in dividends because of its size. Apple will always pay more dividends than, let's say, a REIT like Realty Income, since it is almost a $3 trillion company and Realty Income is only about 40 billion. However, Apple's yield for you as a shareholder is only about 0.5%, whereas Realty Income's yield is currently over 5.5%. So again, in my opinion, this is a bit weird, but it's enough for you to know that this will skew the index towards larger companies. The index is rebalanced quarterly, which means that any changes or discrepancies you see between the rules and the current situation will be fixed within the quarter. So, here is the index behind DGRO explained for you. I personally think it is a decent strategy with some things that could be improved, which I already mentioned. However, I first want to see what are the history, performance, top companies and sectors of the ETF, and only then I will tell you my opinion of the ETF and who should and should not invest in it. Alright, now let's go to the ETF itself and check its performance, yield, dividend growth, and top companies. The iShares Core Dividend Growth ETF has a 2.48% dividend yield, which is nothing spectacular. Basically, if you invest $10,000 as of now, you will get $248 per year. If you invest in the fund, you are probably doing it with the hope of future growth of the dividend and don't rely on that small number of current yield. So let's check how the ETF that is literally created to give you dividend growth is doing in that department. The fund is less than 10 years old, so we don't have data for the 10-year growth rate. However, we can calculate what the overall dividend growth since the inception is on our own. We grabbed the first full year of dividends, 2015, and the last one, 2022, and we put them into the compounded growth rate calculator. For these 7 years, the growth rate of the dividend is 8.86% annually. The 5-year dividend CAGR is 9.66%, the 3-year is 8.76%, and the past 12-month dividend growth rate is 12.04%. These are pretty good results in my opinion, but of course you need to expect that from an ETF focused on dividend growth. Let's now check the performance of the total returns of the ETF. The total return for the past 5 years is 8.58% annualized and 10.09% annually for the past 3 years. Now, as I mentioned in the start of the video, the fund was created in 2014, which means we don't even have a 10-year track record for it. This is always something to note because all of the ETFs created in the years after the financial crisis have enjoyed literally the biggest bull market in history. That means that their performance leading up to 2022 is expected to be great, and it might not be because of their great quality. 2022 was not a financial crisis type of year, by no means, but he had a substantial decline in stock markets with the fastest rate of interest rate increase in history, so it is kind of a barometer for the funds. And as we can see, the total return of DGRO in 2022 were down, but nothing catastrophic really happened, and the fund even increased its dividend in that year. So, despite the okay 2022 year, overall, I can't claim that the fund has been battle tested, having in mind that it has been created near the start of one of the best times for the stock market in history. Let's now look at the fund's holdings and diversification. The top 10 companies are all pretty solid ones. Microsoft, Apple, JP Morgan Chase, Johnson & Johnson, Exxon, AbbVie, Chevron, Procter & Gamble, Broadcom, Pfizer. We can see a healthy mix of 3 tech companies, the biggest bank, 3 pharma stocks, the 2 biggest energy companies, and arguably, depending on the way you classify things, the biggest consumer staples company. Now, at the time of watching this video, this will have changed, so I won't get fixated on the stocks themselves. What I want to see is the screens of the index put in practice and the results they give. And from what I am seeing, I like the result a lot. I even have some of these stocks in my portfolio as individual positions. Speaking of that, if you would like to see my top 4 stocks and ETFs I invest in for the current economic and geopolitical environment we are in, go to the link in the description and I will send them to your email for free. The report will always be up to date regardless of when you are watching this because I am constantly updating it. Now, as you remember, the individual holdings are capped at 3% and we can see that this is applied in the ETF with the exception of Microsoft, which will get trimmed in the next rebalancing event. The top 10 holdings represent 25.5% of DGRO, which is a good level of diversification in my opinion, especially considering other ETFs which are extremely top heavy. The total number of companies in DGRO is over 400, which gives the ETF a huge diversification. As I have discussed in previous videos, too much diversification can be a bad thing, especially if no quality screens are applied and all kinds of weak companies are let in. Here, however, we have decent filters for the index. Again, they're not the best I have seen and are pretty basic, but at least we have them, and so that should ensure some level of quality despite the huge number of companies in the ETF. Okay, now let's go to the sectors in DGRO. At first glance, we can see that 10 out of the official 11 sectors are represented. This is because, if you remember, real estate investment trusts are not allowed into the index. We can also see that the double-digit percentages go to the financials, healthcare, tech, industrials, and consumer defensive. This is an interesting mix. We have 3 cyclical sectors and 2 defensive. The cyclical sectors, which in the top 5 are the financials, technology, and industrials, mean that when the economy goes south, the profits of the companies in it go down a lot more than the ones in the defensive sectors. It is arguable whether technology is one of these sectors if we include companies like Microsoft and Apple, without which we can't function as a modern society, but this is a topic for another video. First, financials. These are companies that provide financial services like banks, payment processing, asset management, insurance, etc. I have shared how I feel about financials in other videos, but to sum up quickly, I don't feel comfortable with investing a lot in that sector because, in my opinion, it is very easily disrupted by technology and government regulation. As a quick example, central bank digital currencies can kill the business model of banks and card companies like Visa, MasterCard, or American Express. Blockchain can kill the model of brokerages or asset managers that provide custodian services because it allows everyone to be in full control of their assets that have the title of the owner in the blockchain, which is only accessible through his or her private keys. I don't want to get carried away here, but these are one of the reasons I have almost no individual financial stocks in my portfolio currently. When they are part of an ETF, the risk is mitigated because if one fails, it won't be as catastrophic. But if, for example, some of the above technologies get adopted en masse, this will really hurt the ETF. The second sector is healthcare. This is generally a great sector to have as a top one in a dividend ETF, in my opinion, because it gives the ETF safe and steady cash flows that are not dependent upon economic crisis or booms. Anyone who is sick already is taking a pill regardless of whether we are in a recession or not. The tech sector comes third. This is totally fine with me because, as we know, this sector is the biggest engine of growth for our society. Unfortunately, it is not famous for its generous dividends because the companies need to reinvest a lot in new technology to stay competitive, but this sector being 16 to 17% of the ETF means that while you are focused on dividends, you will also participate in any tech-related market rally, which I find reassuring. The fourth sector is industrials, which are companies that are in the construction, transportation, machinery, etc. businesses. These sectors' profits go up and down with the economic cycles, so it is more vulnerable to economic downturns. Famous companies include UPS, 3M, Boeing, Caterpillar, etc. I'm generally bullish on the industrial sector of the USA as long as onshoring keeps being a policy in the country and the relationship with China is deteriorating. If you believe the USA needs to build out a powerful industrial base that is not dependent on China, then this is the sector where a lot of the profits of that process will go to. The fifth sector with 10.5% is consumer defensive, also known as consumer staples. This is the sector that produces food, beverages, cleaning supplies, tobacco, different kinds of household items, etc. Naturally, it is very immune to market and economic downturns and provides a stable and steady stream of dividends. Actually, one of the most iconic dividend pairs are part of the sector: Procter & Gamble, PepsiCo, Coca-Cola, Altria, and others. I generally like to see this sector having a bigger part of an ETF. 10.5% is not that high, but combined with the 19% in healthcare, this gives us almost 30% of very defensive cash flow coming from DGRO. Sector 5th to 10th have considerably lower percentages of the ETF invested there. We have utilities, energy, and consumer cyclical at 6%, and basic materials and communication at the negligible 2 and 1% respectively. Just a quick explanation. The utilities sector is full of companies delivering us the electricity, water, and gas we all need to live our normal lives. So their cash flow is very defensive and immune to economic downturns, but they are very heavily regulated. The energy sector has companies like Exxon, Chevron, Shell, Enterprise Product Partners, Enbridge, and others that pump oil and gas from the ground and then store and transport it. More recently, there are also newcomers to the sector from the green energy side. Basically, this is the sector which makes our society not being stuck in the Middle Ages. Also, the companies there are famous for their generous dividend and share repurchase programs towards their shareholders. So I would like to see that sector as a bit bigger part of the ETF. The consumer cyclical sector is the sector that has stuff like luxury items, cars, travel, etc. in it. It is very vulnerable to recessions and rising unemployment because in times like these, people cut stuff they don't need first. However, it is home to one of the biggest and most innovative companies of our times, like Tesla and Amazon. The basic material sector is comprised of companies that dig and process the materials we use to build our buildings, machines, and basically everything. We're talking iron, copper, nickel, silver, etc., etc. This is a very important sector for our society. However, the profit of the companies in it varies greatly in tune with the prices of the commodities they sell. That means that the sector is famous for its big dividend yields that can easily get slashed by 30% for reasons completely out of the company's control. However, if we're going to continue with the green energy transition, there is a lot, and I mean a lot of stuff like nickel, lithium, iron, cobalt, silver, etc. that needs to be mined. So probably the quality companies of the sector will be able to capture that upside. And the last sector with only 1.5% is communication, which is made up of companies that help us communicate. And that's it. If you're getting value out of this video, click the like button and also subscribe to the channel by clicking the subscribe button and the notification bell. That way, you'll be directly notified when I release new videos instead of relying on the algorithm to show them to you. The amount of engagement I get shows me what types of videos the audience enjoys, so I thank you so much for taking that 1 second to do that. It means the world to me. Alright, so what is my overall opinion of the iShares Core Dividend Growth ETF and who is it for? I think DGRO lives up to its name as a dividend growth ETF. The current yield you're getting is low, so the fund is not a good idea for people who want higher current income. However, the dividend growth has been solid and the top companies in the fund are all businesses that will probably continue to grow their payments to shareholders in the future. So, if you're willing to wait years for that yield on cost to increase and create the snowball compounding effect all dividend investors love, then I think the fund is a good choice. At the same time, the ETF has one of the biggest technology names in it, so it will probably continue delivering decent capital gains in the future. However, when it comes to the index screening process, I personally would change some things because it leaves a lot to be desired. For example, I would include quality REITs in the fund, even though that will increase the taxes for some investors. Also, the 5-year dividend growth streak is a bit weak and I would increase it to 10, but I get that the index providers are trying to catch the companies who are on the rise when it comes to their dividends and capture their earlier upside. The filter that I find the weakest, in my opinion, is the shotgun approach of simply cutting off the top 10% yielding stocks in the selection universe. I understand they want to avoid yield traps or companies with unsustainable dividends, but there are far better ways to do that. So, should you buy it? Of course, as you know, I don't give financial advice and only you can decide that for yourself. The way you decide that is through increasing both your investing education and awareness about your own situation and goals. This is exactly why I created the free dividend method masterclass, which you can join by clicking the link in the description. It is a value-packed event where you will probably learn for free stuff that a lot of people would charge for at a seminar, or it will take you weeks to pull them out from a book. So go to the description, click the link, and I hope to see you at the masterclass. Now, as I said, from what I have seen this far, DGRO is a pretty good ETF for dividend growth investors who want to compound their dividends with the so-called snowball effect. Let's go to my favorite dividend reinvestment calculator so that we can see how much can our investment in DGRO and cash flow from it potentially grow. We will start with $10,000 monthly investment. I will then input the rest of the metrics: annual increase in share price, dividend yield, dividend growth rate, and I'm putting 10% tax just so that it isn't zero and to keep it more realistic. I will also put the dividend reinvestment plan, which means that each dividend buys us more shares of the ETF. We will first invest $10,000 once and never touch it. On the 20th year, we have almost $69,000 portfolio worth with $1,800 in yearly dividends. And on the 30th year, the portfolio has grown from $10,000 up to $1 $192,000, and the dividends we receive are $5,200 per year. However, for a lot of people, it is a lot more realistic to simply put aside some part of their income every month and invest it. So, if we invest just $1,000 a month for the next 20 years, we will have $656,000 portfolio worth with $1,400 in monthly dividends from DGRO. On the 30th year, the compounding effect really kicks in, and we have a $2 million portfolio worth plus $55,000 yearly or $4,600 monthly dividends. Alright, but since we are really keen on building our passive income and financial freedom, let's save or earn a bit more and invest $2,000 every month. On the 20th year, the result is $1,312,000 portfolio and $33,795 in yearly dividends. And on the 30th year, our portfolio has grown to the astonishing little more than $4 million, and we have $110,000 yearly dividends, which is a bit more than $9,000 a month. Of course, the numbers will be different because no one can predict the future, but we can see that from both the total return and dividend growth point of view, the DGRO ETF is living up to its fame as a favorite fund for dividend growth investors. So, what do you think about DGRO and the video in general? Let me know in the comments if you own the fund, if you plan to own it, and whether you liked the review or not. I always personally read and reply to every comment I get. And before you go, click on the video that will appear on your screen right now to continue with your investing education. Thank you for watching, and I will see you there.